So good morning, welcome, and thank you for joining us for this edition of On Top of Tax. I'm Ollie Pumphrey, and I'm a corporate tax partner based in the Southeast. Today, we will be providing you with the key deadlines you need to be aware of and in-depth insights on hot tax topics. We will wrap up today's session with a short Q&A, so feel free to drop your questions in the Q&A box at the bottom of your screens. If we run out of time, don't worry, we will follow up with you afterwards. Today, I'm delighted to be joined by my colleagues, Rob, Ian, and Jenny, and they'll be covering year-end readiness, which Ian will be covering. Rob will be discussing staff benefit changes after the budget, and Jenny will be running through the new business tax roadmap released at the same time. Slide, please. And slide, please. So before I hand over to Ian, there are some deadlines to draw your attention to. At the end of the month, we're thinking ahead for the 31st of December year ends, and they should review their 2-year claims and elections. 14th of December marks the 4th quarterly instalment payment deadline for very large companies. And the 31st of December for those companies with a 31st of December year end, it's the final deadlines for filing tax returns, corporate interest restriction returns, both the 2023 year end, published tax strategies for first-time publishers, and R&D claims, the 2-year window for periods ending 31st of December 2022 closes. On the indirect tax side, upcoming compliance deadlines are at the end of the month, 30th of November, VAT instalment payments, 7th of December for monthly and quarterly VAT returns and payments, and again at the end of the year for VAT instalment payments. So, Ian, over to you.
Thanks, Ollie. Good morning, everyone. Thanks very much for joining. So my name is Ian Bowden. As Ollie mentioned, I'm a tax partner and I head up our tax automation and innovation practice. And delighted to be joined this morning by Ian Bacon, who is our head of delivery within that group. We thought the topic that might be quite appropriate to cover today is year-end readiness, given the timing for many of our December year-end businesses. It's going to be a challenging couple of months, and we thought we would pop a couple of areas on screen to help in terms of getting ready for that and some of the obvious pitfalls to consider. So Nat, if you can move us to the next screen. I thought we'd just start off with a very quick poll, if that's all right, just to get a bit of a handle and get you interacting with us this morning. Just keen to find out from you in terms of how do you plan to deliver your year-end numbers? Just leave that open for a minute. We've got 4 options on the screen. Either you are outsourcer, do you outsource those year-end numbers? Do you still use some form of Excel as the basis for that calculation? Have you built something yourself in another system, or have you gone ahead and purchased a third-party tool? So let's just give that another 5 seconds and then we'll get going with some answers, just to give us a bit of a frame for today's conversation. How's that looking, Natalie? Okay, so interesting mix. So we've got, just looking at those poll questions, we've got a small number that are, well, about a quarter that's still outsourced. We've got about half that are still using Excel, a small number that have self-built, and then a quarter that have gone ahead and bought enterprise tools. So that is good. I think we're seeing the numbers certainly increase in terms of those that are buying something specific to help in these types of areas. And there's a lot of conversations and opportunities about how you can holistically use some of these technologies to do multiple things. So some of you may be in Pillar 2 type worlds. How can you use the platforms that you've got? So that's really helpful for us just to get an insight in terms of where that is. But still, the largest chunk of you are relying very heavily on Excel for your year-end numbers. If we can just close that, Natalie, and just pop onto the next slide. We just want to cover 4 key areas. So Ian's going to talk to us in a second about some of the kind of 4 key areas, particularly when he was in-house himself running these, the types of things that he went through to get ready for year end, and then a quick bit on the common pitfalls. one of Ian's areas that he'll talk about is data. And given that half of you are using Excel and a quarter of you are, even those that are outsourcing, there's still a huge challenge in terms of pulling together and getting that data and sending it over. Even for those that outsource, as a company that deals with organizations when they're outsourced, we still spend 40, 50% of our time messing around with that data before we can start doing anything with it. And that's, if we were to give you one key message today ahead of year end, is take a little look at the data that you're either going to send out or that you're going to start using, and try to understand if there's anything in there that's changed, anything in there from a systems perspective that's had an impact, or anything in there that you could do to improve that data before you start this process. This is all pre-year end type activities, and the challenges that an outsourcer has with your data, but also that you will have with your data. Please don't leave this one till the last minute. It really is the most important point for us in terms of making where we're seeing the largest number of issues is around the kind of the data sources, closely followed by those that are still using Excel if something changes, a cell changes or something breaks. But from a data perspective, that's our starting point. But I'm going to hand over to Ian, and he's got 4 areas and then some common pitfalls to walk us through in terms of the things that he did when he was in-house, and the same conversations we have for groups that are getting ready for year end. So, Mr. Bacon, over to you.
Thank you. So what we've got here is clean data, as Ian's already said. Now, data is the key to any close. If you don't have the right data, you're going to get the wrong results. But who owns that data process? And is it tax or is it finance? That whole business is probably too late now, but it's something to think about as you're going through the close. Who should be ultimately delivering that data for you? And have you communicated as tax those requirements to your finance teams to make sure that they know what you're actually looking for, rather than a request coming in halfway through the close? So clean data wise, it's all about making sure that you're asking for the right information at the right time, hopefully before you actually move into close, so everybody knows where they're sitting. But also that data, what's available there? Is it standardized? What's available for pre-processing? So could you perhaps do 11 months, process 11 months of data and use that in your provision? Does it have to be 12 months of information that you're using in that close process? Could you actually use your tax return information? A lot of clients do have their tax returns, probably putting in the prior adjustments as we speak into your current year-end process. Could you actually use some of that tax return information to act as a proxy for your provision information to help you get through your close process? It is, after all, a provision. It's not supposed to be the exact number, but it's supposed to be reflective of what your business is doing. And that's really a key consideration when it comes to data. Moving into kind of the policies, procedures, and real-time evidencing. This is all about who is the key person in your close. What happens if they're sick during your close? What impact is that going to have? Hit by a bus is the classic question that gets asked.
We say win the lottery these days, Ian. We don't use the bus analogy anymore. Okay.
Well, I still use the hit by a bus because that's a permanent loss for me. But no backup cover. Who's going to back them up? Who is going to cover if they're not in, and do they actually know what each other do? So that cross training between team members is quite an important piece. Those who are outsourcing are obviously less prone to this, but that data still needs to get to your outsourcer. So who's the backup contact? Other methods that you can use in your procedures is entity stratification. Do you have to do a full calculation on every single entity? So could you take a large chunk of your entities to one side and do those at PBT at the rate? That way they're easy. Maybe finance can do that process for you for those entities, and you focus on purely the material entities. Different ways of managing your process to make sure you get to a materially correct result at the end. And then what documentation could you get ready before you actually go into close? Is there any business transactions that have taken place during the year that you would have to provide to audit your auditors? Could you do the write-ups of those before you even get into your close process? Chances are, if it's a business transaction, almost certainly you could. Next slide, please.
Just on that policies point as well, I guess, a lot of groups will have SOX controls they'll be providing in for US organizations and everything else as well. Again, it's giving those documents, making sure that they are adding some value as well. SOX controls are there for a reason, but they should also add some value. So if you are controls that are there that aren't adding value to the process and are complicating it, it's worth flagging those now or mentioning those now so that for next year they can be looked at in more detail and try to identify it. Obviously with UK SOX and various other things on the way, SAO, there's a lot of paperwork and documentation that needs to be done, but making sure that that's up to date ahead of time and that those policies do run true is helpful in people considering dry runs. But sorry.
Go with the next slide. Thank you. Moving into technology, so there's quite a large number who have taken up third-party technology. That obviously, just because you've got technology doesn't mean things are going to run smoothly if you don't keep it up to date. So do you use that software regularly? When was the last time you used it? If you're using it on a monthly or quarterly basis, chances are your team members are fairly up to date with how it's working. But many of our clients do use it annually. Do they need a reminder? Perhaps a dry run would be useful. Maybe on month 11, probably on the last quarter might be useful, so that you can make sure everybody's up to speed, still got access to the tool to actually run that close. When was the last time you used your spreadsheets? Have you taken the cobwebs off of them to make sure that they're still functioning and are ready for your close? Now, ensuring your metadata's in sync. Have you got the accounts synchronized? Are any new accounts and new entities? Have you updated all your spreadsheets, produced the templates for them? All of these things in the technology space, it's there to help us, but it does need a bit of help itself to make sure it meets your needs. And of course, what can be put into the technology, sort of preloaded before you even get into your close cycle. A lot of this stuff, the technology allows you to put it in before, so you don't have to put the data in during the close itself. If you can get it in before, do it now. Saves you time when you're going through that overall process. And then we move into people, perhaps the most important part of any close process. People are the ones that drive the process. We are the ones that make it happen. And it's a team game. Communication is the most important piece. Have you communicated your plan? Have you communicated your close schedule? Does everybody know what they have to do and by when? The communication between finance and tax is really, really important. Ensuring finance know what tax needs. Finance also know that when late adjustments will inevitably come around, a pain point that we all go through, finance knows that you can't give an immediate answer. You need to process that information, and you've got a turnaround time. Making everybody aware of those turnaround times is so important in the close cycle to make sure that tax doesn't feel like they're working till midnight during a close cycle. It's really important. I can't underestimate the importance of people and making sure that communication between teams takes place. That is the piece that makes this all work, and making sure that everybody knows where they stand, what they're doing, and when is a really important part of that close process.
Yeah, whether you've gone to the trouble of producing the racy matrices or anything like that, but you need to, have something simple, a document that has your timetable, so that everybody's clear of when you're going to be producing your numbers, when you need access to the system, all of those types of things. When we touched on the technology, it's important that make sure that users have got access, rights, IDs, passwords, all of those kind of basic things. But that also needs to be communicated more broadly, because there'll be periods when books are closing and you're going to have to try and do your parts in a very quick period. So publishing the tax timetable is a hugely useful exercise, so that people are all clear when you need access to data and when you need to be left alone for a few hours to pull the numbers together. So however you go ahead and do that, whether it's very formal or something informal, please do produce the timetable.
Next slide, please, Natalie. And finally, common year-end pitfalls. Now, I've been burnt by these myself many a time, but the number of times they repeat is pretty common. So if you get ready now, you will avoid many of these pitfalls. The most common pitfall is the late adjustments, the hard close, tax rates not being up to date, maybe some old rules because you haven't updated yourself for the current laws. That maintenance of those processes and systems. It's also a good point to mention that if you want to make sure that you're getting the most out of this close and you're looking to improve in the future, maybe collecting some information about what actually took place, what pitfalls you fell into this close, not just trying to avoid them this year, but despite your best efforts, did they reoccur? Reoccurring pitfalls lead very well into business cases for change. And next slide, Nat. And with that, I'll hand back to Mr. Bowden.
Yeah, just to close it out, hopefully that's been useful. As a very quick canter through, there is a video. We have produced a very detailed document in terms of the things that you need to consider for year end. If anybody's interested in that, please let Ollie know and we'll pass that along. But as Ian alluded to there, it's as you're going through your year end, can you pull together where do you spend your time? And while it's fresh in your mind, where are you having to ask for rework data? Where are the systems not working how you need to? Those types of things become super valuable if you need to do a business case. With 50% of you on this call still using Excel as the main engine for your process, even if that continues to be your process, what could you do to improve that? But is there something that you could pull together that would help you produce a business case? Business case isn't always just going to be about taking head count out of a particular process. You also need to look at the broader points around risk and savings and everything else in terms of as people are more and more pressure of the tax functions. So there's a couple of points here, and Ollie will send out the slides afterwards, so we've got a copy of them. But there's a couple of areas that are worth considering that help you build the business case. And we spend more and more of our time at the moment trying to assess the options and help people build a business case for change. But please do capture how your year end goes, because as all tax people, we have quite short-term memories. When we finish our year-end close, we get stuck into the next set of challenges that are ahead of us, and the pain of year-end fades. So please do capture some of that pain. It will help us articulate it and hopefully make some changes next year. With that said, that's us for year-end. I hope it goes well for everyone. Good luck. And I'll hand over to Rob, who's going to give us a bit of an update on employment taxes. Thanks, Rob.
Well, thanks, Ian. Good morning, everyone. I'm Rob Woodward, Associate Director Employment Taxes, based in our London office. I'm just going to cover through some updates following the recent budget. Next slide, please. Just before we dive into the details from the budget and a couple of key areas, just an update on some employment dates coming up. So the monthly payments for PAYE through the RTI system, with the 19th December, 19th of January, and obviously 19th February, etc. But also for the 31st of December, directors' loans, paying those back by the 9 months before the year ends. Bear in mind, of course, that for the beneficial loan reporting as well, but there's that is also going to be taking place as well on the 31st of December. Next slide, please. So as I say, I'm going to cover off some bits that came out of the budget. Firstly, the headline grabber from an employment tax perspective was the increase in employers' national insurance. This is going up from 13.8% to 15%. However, this will not be taking place during the tax year, which is helpful. If anyone remembers back to November 2022, when there was a change partway through the year, which caused lots of problems from both a payroll point of view and also understanding what the blended rates of national insurance was. So there's a little bit of time before it goes in April 26th of April 2025. As the employer national insurance rates through payroll also applies to benefits in kind, there will be a corresponding increase in the Class 1A and Class 1B NIC rates as well, that are used for benefits reported through the P11Ds and PAYE settlement agreements. In terms of context, it's probably worth noting that the UK remains roughly in the middle of the G20 in terms of the employer social security rates, and actually is the lowest of the European countries within the G20. That range within the G20 overall is from under 10% in South Africa, Canada, Mexico, and the US, but over 25% in China, Brazil, Italy, Russia, and France. So we're still very much within the middle there. It is obviously an increase, but in a global context, we're not an outlier. In addition to the increase in the rates of employers' national insurance, it was also announced that there will be a decrease in the threshold at which the employer's national insurance becomes payable. This will obviously have an impact on both the amounts that employers will pay for employers' national insurance, but also potentially bring in more part-time workers into scope. And on that point, combined with an increase in the national minimum wage and national living wage, in particular, that has been seen as an impact in care home, leisure and hospitality, and retail sectors. There's a disproportionate cost increases for those, although generally an employer's cost increased across the board. For small employers, though, those with a total employer and NIC costs up to £100,000 a year, the employment allowance, which allows to reduce that cost, is increasing from £5,000 to £10,500 per year. Although it should be noted that where the employers are connected through common ownership, that's £100,000 annual limit is the aggregated amount. So they can't subdivide, groups can't subdivide and claim multiple allowances. Most large groups will not be able to claim the employer's allowance. But for smaller employers, obviously that is a help and help mitigate some of that cost increase. All employers, though, there is a 0% employer national insurance rate up to what's known as the upper earnings limit, the 50,000, which is £50,200. That is for apprentices on qualifying apprenticeship schemes who are aged up to 25, employees who are aged up to 21, certain forces veterans, as well as employees in free ports and investment zones. So this may have an impact on future hiring decisions, as well as changing staff matrices as well. So employers might be looking at those as an opportunity to mitigate the cost increases. One thing that wasn't announced in the budget, which is good, was that in the run-up to the budgets, there have been a lot of press speculation whether there will be an imposition of employers' national insurance on employer pension contributions. Thankfully, that didn't materialise. And so employers who don't currently operate their employee pension contributions on a salary sacrifice or salary exchange basis may wish to further consider the opportunities under salary exchange or smart pensions, whereby employees reduce their salary in exchange for increased employers' pension contributions, because that could help mitigate some of the employers' national insurance increase, because that salary sacrifice will not give rise to employers' national insurance. There'll also be a small apprenticeship levy saving. And for the employees, there will be potentially a tax saving, depending on their marginal rate of tax, but also they will receive their tax relief on pension contributions in real time, and also employees will save national insurance. So there is a benefit there from the salary sacrifice pensions. Next slide, please. Major change as well that was announced was that from April 2026, following a press release from HMRC in early 2024, from April 2026, benefits in kind will have to be payrolled, so reported through payroll, reported on real-time information. For most employees currently receiving a P11D, this will mean that they will no longer receive one after the 6th of April 2026. Obviously, payroll systems will need to be updated to take into account the change, not least because it was announced there will be additional, but as of yet unspecified, further reporting of details of those benefits through payroll. Obviously, careful handling of this will be required, not just on payroll side, but also because under the current system, unless the employee files a tax return, which is not the case for most employees, they will pay tax on the benefits reported on their P11Ds through what is known as a PAYE coding adjustment. Effectively, that collects the tax in the next tax year, so there's a time delay. But under payrolling of benefits, the tax is collected on a real-time basis, and therefore, in that first year of payrolling benefits, employees may ask why they got a double tax charge, where they're effectively paying tax on benefits for 2 different years at the same time. So careful handling, careful communication will be required for that. So in order to help with that, with that messaging, also for preparedness as well, employers can voluntarily register to payroll benefits, and many employers have done already. This will help both acclimatise, ensure systems are ready, but also can be on a particular benefit basis rather than across the board. So maybe help smooth out that potential effective double tax charge. The only thing to bear in mind with payrolling benefits, voluntarily payrolling benefits, is that it requires agreement with HMRC. And that agreement needs to be in place before the start of the tax year. So if anyone wants to voluntarily register for payrolling benefits ahead of it becoming mandatory, that will need to be in place by the 6th of April 2025. There are 2 exemptions to the mandatory payrolling of benefits. This is because HMRC effectively have admitted that taxable employer provided accommodation and beneficial loans over £10,000 are just too hard to report through payroll. The HMRC systems aren't ready yet for that. So for those employees who are in receipt of either of those, most likely to be directors with directors' loans, they will still be receiving P11Ds. So there'll be effectively a hybrid system for them with both P11Ds and payrolling benefits. HMRC have extended the opportunity to voluntarily register for payrolling of these benefits, but obviously bear in mind that it's accepted that the systems aren't in place yet for that. So that will obviously require adequate payroll systems, and also HMRC being ready for those benefits being able to be reported in real time as well. Consequentially, we don't anticipate very many, if any, employers will actually voluntarily register to payroll employer-provided accommodation or beneficial loans. Next slide, please. The final bits I wanted to cover was in respect of employer-provided vehicles. Following a recent case involving Coca-Cola, the benefit-in-kind treatment of double cab pickups, which are those vehicles with four independent doors, and passenger seats behind the driver, with a flat pickup at the back, and that have been used by some as family vehicles. The benefit-in-kind position will change from April 2025. Previously, HMRC accepted that if the vehicle's payload was at least 1 metric ton, they would be considered a company van for benefit-in-kind purposes. And that was important because company vans have a flat rate charge rather than the company car charge, which is based on the vehicle values and emissions. And generally, that flat rate charge is lower than for company cars. The change means that from April 2025, each vehicle needs to be assessed on its merits, in particular, whether it was constructed and provided primarily for conveyance of people or goods. And if primarily a people carrying vehicle, it will be taxed as a company car and obviously therefore have a higher taxable value, or expect to have a higher taxable value. HMRC have said that they expect most double cab pickups to be taxed as company cars from 2025. So for the other employer vehicle change announcement was that electric vehicles, the beneficial rates for electric vehicles will be extended to April 2030. And as a result of that, employers may look to pivot from double cab pickups, where they've been provided more as a company car, to electric vehicles. Obviously, you need to bear in mind such things like early termination of leases and also cost of disposal of these vehicles. But there is an opportunity there when employers are looking at their vehicle fleets. And just the final point on that is that electric vehicles aren't caught by what's known as the optional remuneration arrangement legislation, so can be provided under a salary sacrifice basis in the same way that pensions can. And again, that would result in reduced employer national insurance. So to help mitigate the cost increase that was also announced and I've covered previously. That's it's in terms of the employer updates. I'll now hand over to Jenny.
Hey, good morning, everyone. I'm Jenny Plummer, a corporate tax director in the Southampton office, and today I'm going to be talking to you about the corporate tax roadmap. I don't want to say that they've saved the best till last, but obviously hope that you might think that at the end. Natalie, if we could have the next slide, please. I'm going to start with some background on the aims of the roadmap and how that fits with the government's overall strategy for taxation. Now, as I'm sure you're aware, Rachel Reeves announced her first budget at the end of October and set out a number of measures to fix the foundations of the UK economy. Her aim is to restore growth by supporting the economic and fiscal stability, boosting investment, and increasing spending on public services. And she set out a raft of measures to help her achieve this, raising taxes to help balance the budget for day-to-day spending, announcing plans for public sector investment, and unveiling a corporate tax roadmap to help create a stable and predictable environment for private sector investment. Now, as you might expect, given the wider economic environment, the focus of the roadmap is on stability rather than any tax cutting measures which have been the focus in the past. It considers how the UK corporate tax regime can best support business and makes several commitments designed to make the UK the most attractive major economy in which to invest and do business. The roadmap also outlines some further consultations which focus on strengthening the UK's position or simplifying the existing rules. Yeah, if we could have the next slide, please. The headline commitments mostly reaffirm the current tax system with some tweaks and include capping the headline rate of corporation tax at 25% for this Parliament, continuing to monitor international developments to ensure that the UK's regime remains competitive, and maintaining the small profits rate and marginal relief at their current rates and thresholds. As you can see from this slide, this puts the UK as the 13th lowest corporation tax in comparison to the rest of the G20. Next slide, please. As well as promises on the corporation tax rates, the government's also committed to a capital allowance regime that supports business investment, is competitive internationally, simple to apply, and flexible to allow businesses a choice over which allowances to claim. To achieve these aims, commitments were made to maintain full expensing relief on a permanent basis throughout the Parliament and to maintain other core capital allowances, which include the £1 million annual investment allowance, writing down allowances on plant and machinery and special rate pool assets, and the structures and buildings allowances, which provide relief for capital expenditure on the purchase, construction and renovation of new non-residential structures and buildings. And the government's also stated that they'll explore further ways in which they can provide greater clarity on what qualifies for the different capital allowances. And this is going to build on the guidance that they've already released in relation to computer software and the interaction between full expensing relief and the annual investment allowance. They'll also look at the simplification of the capital allowances legislation, whilst acknowledging that this has already been achieved in part through full expensing relief. As well as this, they're going to look at the tax treatment of pre-development costs through further consultation, with a focus on encouraging investment in the renewable energy sector and major infrastructure projects. Finally, consideration will be given to an extension of full expensing relief on assets that are bought for leasing or hiring when fiscal conditions allow. This final point may be disappointing news for those affected, as previously we'd expected capital allowances to be extended to the sector more immediately. As you can see, there is also good news in respect of the R&D tax relief regime. After significant changes to the reliefs available in recent years, the government has now committed to maintaining the rates of relief for the merged R&D expenditure credit scheme and the enhanced support for R&D intensive SMEs. It's worth noting that the RDEC rate of 20% represents the joint highest uncapped headline rate of R&D tax relief in the G7 for large companies, meaning that the UK continues to be an attractive place to carry out R&D. In future, the government will consider further simplification and incremental improvements to the regime, but do not expect further significant changes, allowing businesses the certainty over the tax relief available, which is often critical at the R&D stages of development. Now, to ensure that the relief is targeted at the right businesses and to help combat error and fraudulent claims, the roadmap also sets out how the government intend to improve the administration of R&D reliefs. They will establish an R&D expert advisory panel, continue to improve signposting and guidance on the R&D tax reliefs, and launch an R&D disclosure facility by the end of 2024, as well as using existing powers to tackle agents who breach the agent standards. In addition, and to help improve customer experience and provide further certainty to business, the government also plans to launch a consultation on the use of advanced clearances for R&D release in the spring of 2025. The government have also committed to maintaining the patent box and intangible fixed asset regimes in the UK. Welcome news, given that the rate of tax on patent box profits is 10%, and that's become increasingly beneficial now that the main rate is set at 25%. And there is also no change to the intangible regime, which has been designed to support investment in the UK's knowledge-based economy. In terms of other corporation tax reliefs, the roadmap also confirms that audiovisual expenditure credits and video game expenditure credits will be maintained, and that they'll launch a consultation to review the effectiveness of land remediation relief in spring 2025 to determine whether it still meets its objectives of boosting brownfield development and providing value for money. Next slide, please. The roadmap also reiterates the government's aim to encourage international trade using a tax system that allows fair competition whilst protecting the UK's tax base. And as part of this, they confirm that there'll be no changes to several key structural aspects of the current corporation tax system, including the territorial scope, the loss relief rules, and the UK participation exemption, which, as shown on the slide, is made up of three key elements: the substantial shareholding and dividend exemptions, and the zero rate of withholding tax on dividends. The government is also committed to maintaining a flexible approach to the taxation of foreign branches and will ensure that the UK continues to hold a strong treaty network. There are also announcements in relation to transfer pricing and a statement that they intend to launch further consultation on reforms to transfer pricing, permanent establishments, and the diverted profits tax, with the aim of providing improved certainty to businesses. The government will consider the potential removal of the UK to UK transfer pricing rules, as well as lowering thresholds for the transfer pricing exemption for medium-sized businesses to align the UK with its international peers. They will also consider introducing a requirement for multinationals in scope of transfer pricing rules to report cross-border related party transactions to HMRC, with a view to facilitating the identification of transfer pricing risks and more targeted HMRC inquiries. They have noted that any additional compliance burden will be proportionate and in line with their international peers. There will also be a review on the treatment of the cost contribution arrangements, where the costs of developing IP are shared by group companies to ensure that the rules are certain and do not deter investment into the UK. The government also noted their continued commitment to the Pillar 1 and 2 initiatives, and that they will take the opportunity to simplify other aspects of the UK tax regime where these are now covered by the new rules. For example, in respect to the digital services tax when the Pillar 1 rules are in place, and as well as reaffirming their commitment to repeal the offshore receipts in respect of intangible property legislation from the 31st of December 2024. The roadmap also noted that domestic legislation in respect to Pillar 2 would continue to be updated to reflect internationally agreed updates. Finally, the roadmap set out the government's views on modernising the administration of the corporation tax system with the aim of improving customer experience and compliance. The government recognises the benefits of integrating tax within the day-to-day systems and processes of businesses, but recognises the diversity of businesses within the scope of the rules and the complexities that that brings. The government will therefore work closely across the industry and advisory profession to find the best way forward for the future administration of corporation tax, and further details will be set out in the spring. Next slide, please. The commitments set out in the corporate tax roadmap are generally positive. The stability and certainty provided is likely to be welcomed by businesses operating in an economy that has suffered a number of economic shocks over the past few years. Brexit, the pandemic, the energy shock caused by the Ukraine crisis, and the new uncertainty caused by the results of the US election. However, it will have to be weighed up in terms of the overall package of tax measures, illustrated on this slide, some of which Rob discussed earlier, to determine whether or not it achieves its overall objectives to encourage private sector investment the government is hoping for, and ultimately growth in the UK economy. I'll now pass back to Ollie for any questions.
That's great. Thank you. Thank you for that, Jenny. And as you say, I think some encouraging news for businesses in terms of stability going forward. We have had some questions come in. Do please keep those coming in, and we'll get through as many as we can. Whether that's any mopping up of budget points or any other topics that we've covered today. The first question we've had in, I'm going to direct towards Ian. If I read it out, and Ian, if you'd like to come in and answer it, it's the question says, we still use Excel for tax provisioning as the cost is still outweighing the benefits regarding software. We are slowly starting to integrate Alteryx into our business. The first project is covering VAT. How do you see Alteryx being used for tax provisioning? Ian.
Thanks, Ollie, and good question. I think there's a couple of points to unpick in that. Firstly, it's probably worth pointing out that there's been a bit of an influx of new software vendors as well that have come into that tax provisioning market that is starting to drive costs down. So if you haven't looked recently, we're more than happy to chat with you about some of the options. Some of the mainstream software vendors have brought costs down. Some new entrants to the market are forcing costs down. And if you have a broader system implementation that's looking at consolidation systems or accounting systems, one or two of those give away provision tools for free. So it's worth just doing that assessment first before putting them in the too expensive bucket. I think the other thing to note on here is that we really like these data wrangling tools like Alteryx. Microsoft have some as well with their Power Automate type solutions. We think they're fantastic for doing the data wrangling and moving things around. I think it's worth noting the difference between provision tools, which are ultimately calculators. And the idea with some of the provision tools is that there's the option there to integrate with other tools in the suite, because we're going to have more and more of a holistic view in terms of provision, returns, stat accounts, and Pillar 2. And if you've got different solutions for different areas, moving data between all of the different products and different Excel spreadsheets and everything else becomes a bit of a pain. So do think about it holistically. We do like Alteryx. We think it's great. It's very helpful, particularly for transaction line level, for data wrangling. So for VAT processes, it's fantastic at being able to apply the same processes each time. Where I get a little bit twitchy is when you start using Alteryx for the full calculation side of things. It's great at data wrangling. It's great at reducing that 40–50% of cost you spend getting data in the right format. Ian mentioned something around, could you automate some of the simple stuff in a period 11? Could you take some of your non-material entities and do a PBT rate? Absolutely. Alteryx is wonderful for those types of things, but don't get Alteryx to do too much for you in that process. It's great if you're doing a PSA calculation, a P&L analysis, some of the VAT stuff, some of the VAT reclaim, but there's a line at which it becomes you're ending up having to build so much complexity into it that it becomes risky and dangerous, and you're better off opting for these tools. But I think Alteryx is great for simplified processes and doing some data wrangling, but don't try to make it a calculator, because it isn't.
That's great. Thank you. Thank you, Ian. Rob, can I bring you in on some of the employment taxes questions we've had? We've had a few. One's asking about whether there's a difference between salary sacrifice and salary exchange.
But the answer is no, there isn't. It's just a different terminology. It's exactly the same thing. It's just some people call it salary exchange, some people call it salary sacrifice. Just
So
really semantics.
Nice, quick, easy one. There's another one on PAYE settlement agreements, and the question asks, will PSA items still be reported separately from April 26 rather than going through payroll?
Correct. Yeah. So anything that's on a PAYE settlement agreement there will still be the separate reporting of that. That will still be an annual process. See, as part of the payrolling benefits, employers may wish to consider whether they want to be covered by PSA. PSA is subject to agreement with HMRC. They can't just switch everything to settle by PSA, and obviously PSAs are more expensive because employers settling the tax on behalf of the employees on a grossed up basis. But yes, anything that's in a PSA won't be covered by payrolling benefits and still have a separate annual return.
Great, thank you. Whilst we've got you, it's another question on the employer allowance threshold of £100,000 and whether that might be completely removed from April next year.
We haven't seen that's going to be removed. There was an announcement in the budget that said that any employer that didn't qualify for the allowance because their employer's national insurance total exceeded £100,000 in the previous year meant they couldn't claim it the next year. That's been removed, so each year is assessed on its own basis. But in terms of just the removal of the allowance, there's been no saying that that's going to be removed. So that is continuing as far as we can see.
Great, thank you. There's been a question on investment zones and where can we see where the investment zones are. Just to touch on that, I'm not a specialist in the area, so if you've got any specific questions, do feel free to follow up with me. I'll put you in touch with the right person. But my understanding is that under the previous government, there was this introduction of investment zones, and the Labour government is committed to establishing 13 investment zones across the UK, 8 of which are in England. 2 will be in Scotland, and 2 more in Wales, and that leaves 1 left over TBD. My understanding is that the areas are broadly known, and it will depend area by area as to where exactly those boundaries are drawn up and which incentives each authority makes available in those zones. Broadly, those areas are East Midlands, Greater Manchester, Liverpool, North East, South Yorkshire, Tees Valley, West Midlands, and West Yorkshire in England. And then, as I say, others in Scotland, in Glasgow, North East of Scotland, Wales, Cardiff, and Newport, and Wrexham and Flintshire. So my understanding is that there's still some work to be done there, and some decisions to be made on where exactly those boundaries will be drawn. We've had, Rob, to bring you back in, we've had a couple of questions on double cab pickups.
Mm-hmm.
My first question when I first came across this is, what is a double cab pickup? It's good to know whether you've got them or not. Some people clearly do. Maybe we'll start with that question. But my understanding is broadly that it's a pickup truck with seats in the back as well. So I think the point here being that it's possible to basically use them like you would a sort of family car for take your kids to school and do your shopping.
Yeah, exactly that. So yeah, it looks a pickup truck, but it's like hybrid between a pickup truck and a family car. And I know from family members who my brother-in-law runs a business, and he's had one before and used it as effective as a company car. He does use it for business as well, but yeah. So, but I don't think the chance of specifically targeting him, but you do see these vehicles around, but so they're going to be treated as cars. And one of the questions that did come in was around grandfathering. So yes, any vehicles that have been provided, they're currently double cab pickups being used and taxed as a company van, that will continue after 6th of April 2025 up until the date of that vehicle being disposed, or 5th of April 2029. So there's going to be a grandfathering. So to be clear, the changes in respect of new vehicles that have been taken from the 6th of April. Obviously, any replacement vehicles will have after 6th of April will be fall under the new regime, but there is going to be a grandfathering for vehicles currently on the road that have been taxed as company vans.
No, that's great. Thank you. And taking a step back for a minute on the budget changes, clearly the national insurance contribution increase is going to have a major impact. What I've been saying to people is that broadly, my view is that everything that was sensible before is still sensible, if not more so. So things like salary sacrifice, things like electric vehicles, cycle to work schemes, employer contributions to pensions make even more sense now than they did. So for companies that don't have those sorts of arrangements in place, I think it's certainly a sensible time to be looking at those. And in terms of legislated company share schemes, Rob, I think there's no specific changes to those as far as I'm aware. The changes really are around the corporate capital gains tax rates.
Correct. Yeah. So the existing schemes, the EMI schemes for qualifying businesses, company share ownership plans, save as you earn schemes, etc. That the tax advantaged employee share schemes, they haven't changed, as you rightly say. There's an impact in terms of the capital gains tax rates going up, but they're still lower than the employment tax rates, the PAYE and employers national insurance.
So I think those sorts of schemes are still certainly worth considering, albeit the benefit there isn't perhaps as great as it was a few weeks ago.
Indeed.
So I was working my way through some of the questions. Rob, you're a popular man today. There's another one on the process of reporting beneficial loans to directors. And the question is whether there's anything known about the process of reporting those once P11Ds cease.
Not at this moment. What we anticipate, so prior to April 2016, there used to be a rule around sort of lower paid employees having only certain benefits were taxed, and with what's known as P9D, so had only certain benefits on that. We're anticipating something similar to that in the future after April 2026 for reporting of employment-related loans and taxable employment-related accommodation. But then nothing has been announced yet. I doubt anything will be announced before the until sort of early 2026, as is typical with HMRC when these changes come out.
Thank you. There's another question that's come in. This is in the corporation tax roadmap section, Jenny. So there's the slide on corporation tax rates of the G20 members, and the slide suggests that the UK falls somewhere in the middle. Diving into that a bit more detail, those ranges go from 20% in Russia and Saudi Arabia to 35% in Argentina. Obviously, the headline marginal rate for UK companies is 25%, but it's just been flagged that there are other countries with a 25% tax rate as well, including China, France, Turkey. So in terms of the overall competitiveness of the UK, I think it's fair to say we're somewhere in the middle. The one to look out for is always the US, where it's noted as being a 21% rate, but of course the US is a relatively complex tax system in that you've got federal taxes and tax at state and even city levels. And once you factor into those into the calculations, that number can certainly move north of 25%, even towards 30 or even more. But I think that's really dependent on the states in which you choose to operate in. Jen, I don't know if you had any other sort of thoughts or comment on that.
No, I think that's right. And I think that slide does just show the federal tax rate, so possibly slightly misleading. But yeah, it potentially makes the UK more competitive, I guess, once you take into account state taxes. And who knows what Trump will do when he gets into power, and may make the US slightly more competitive, but we'll see.
Yeah, no, thank you. And of course, that particular analysis didn't take into account companies that may benefit from advantage tax regimes like the patent box or R&D tax credits, which can bring that effective rate down significantly. If companies have a substantial part of their income from patented items, that effective rate can be down as low as 13% for those companies. Just going through the questions. One more, just to come back onto the double cab pickup, just to make sure that question's closed out. It's asking whether they're going to be looked at individually, and looking at the driver's job or responsibilities or role. Is it specific to the vehicle, or is it specific to what that vehicle's being used for? I think is what this question's coming down to.
Yes. So it primarily is going to be what was the vehicle constructed for, what was the primary purpose of that. But there is going to be a holistic consideration as well, because if the vehicle, what is the vehicle being primarily constructed for, but also what is it primarily being used for? So they might be role specific as well. So the answer to the question is essentially both. You look, your starting point is the vehicle. If it's clearly constructed for people carrying, then it will be a car. But if it is can be used for primarily used for conveyance of goods, but provided to an employee who's only going to use it for ferrying people and carrying people, then it can be taxed as a car. So I think you need to consider both, look at everything in the round.
Great, thank you. We'll draw the Q&A section to a close there. Thank you for those questions. Apologies to those that we didn't get round to. We've captured those, and we'll follow up with you individually afterwards. So looking ahead to upcoming events on the 27th of November, we have the Tax Automation and Innovation webinar. If you'd like to hear more from Ian, part 18 of our ongoing webinar series, which are 30-minute snippets designed to arm tax and finance leaders with the information they need to create efficient and low-risk tax processes. On the 28th of November, we have the Workplace Evolution webinar, the third webinar in this series, and it's looking to discover how to provide the right benefits while ensuring costs and tax efficiency. On the 5th of December, what it means to be a large business and why it matters. This is our first webinar in a new series, which will explore how businesses can prepare to be a large business, refine or enhance their strategies to align with HMRC expectations, strengthen tax governance, manage tax risk, and optimize their tax operating model to safeguard their reputation. On the 12th of December, we have Pillar 2, the Global Minimum Tax Compliance webinar. This update webinar focuses on the current state of Pillar 2 implementation around the world. We'll explore how to design, instigate, and operationalize an effective Pillar 2 tax operating model for your organization. And then in a month's time, 18th of December, our next On Top of Tax webinar. To stay up to date, please sign up to our monthly On Top of Tax newsletter to get a monthly roundup of the most important tax updates from BDO, plus exclusive invitations to our webinar series. And for quick updates and insights, do join our On Top of Tax group on LinkedIn, where we share timely BDO tax news. So as the clock hits 12 o'clock, thank you to the panelists. Thank you for everyone joining, and goodbye. Goodbye.